and BPR. So lovely music. Hope you enjoyed that as well this morning. So my name's Laura, and I'm a senior tax consultant here at PD Tax, and I'm also joined today by Lewis, who's also a tax consultant, and we've also got Laura Brennan on the line. She's also a tax consultant as well, so lots of us here today. So a little bit about PD Tax before we start. So our aim is to enrich lives by making tax simple. So our aim is to make sure that our clients are paying the right amount of tax, so the correct amount of tax, but also that they're paying as little tax as possible, and making sure that we're considering all the reliefs and exemptions that may be available for them. So a little bit about what we do. So we provide tax advice. We also have a tax director service for accountancy firms. We prepare tax returns. We can also prepare share valuations for companies, and we can assist with tax investigations and voluntary disclosures, amongst a wide range of other things that we can assist with. So a little bit of housekeeping before we begin. So we're aiming to finish this webinar around 10 a.m. So your microphones will be disabled throughout the webinar. However, if you do come up with any questions, please type them into the question Q&A box at the bottom, and then Laura B will ask us those at the end if we've got enough time. If your question isn't answered, we can contact you afterwards for a follow-up discussion, and we will also have a breakout session at the end if you'd like to stay on for that. Just to note, this presentation is for general information only, and it's not intended to constitute individual advice. So if you are thinking about taking any action, we recommend that you seek competent professional advice before you do so. Okay, so now moving on to start our webinar. So this slide provides a summary of the general principles of APR and BPR and a pro forma calculation to be used. So what you would do is you'd take the value of transfer for inheritance tax purposes, and I've put some examples in that box there where you might have a value of transfer for inheritance tax purposes. So that might include a lifetime gift to a trust, deemed transfer of assets in an estate on death, distribution of assets from a discretionary trust, so you've got an exit charge, or a discretionary trust principal charge, the notional transfer there. From that value, you then take away the BPR or APR, so the value attributable to relevant business property or agricultural property, and we're going to look into what they are later on. So then from that, you then take away any annual exemptions that are available, and that would leave you with your chargeable transfer. So I'm now going to pass on to Lewis, who's going to start us off by talking a bit more about APR.
Thank you for that, Laura. So agricultural property relief, or APR, is probably less well known than business property relief. However, it works in a similar way to BPR. APR reduces the value transferred when assets such as farmland and farm buildings are gifted either during lifetime or on death. As Laura has just pointed out, APR is given before any available annual exemptions and is available at either 50% or 100%. It's worth noting that if an individual dies and their estate includes agricultural property, APR can also be given as a deduction in their estate when calculating death tax. So what is agricultural property? Agricultural property means agricultural land or buildings used for the purposes of agriculture and situated either in the UK, the Channel Islands, the Isle of Man, or a European Economic Area state. Agriculture is not exactly defined, but includes horticulture, for example, growing fruit, vegetables, and crops, as well as farming for human consumption and other products such as wool. Agricultural property relief is primarily available in two situations. One, to a farmer who owns the land and buildings and uses these assets in their own business, and two, to a landowner who is letting out agricultural land or buildings to a farmer. There is no requirement for the landowner to actually farm the land themselves in order to qualify for APR. There are also activities which are specifically excluded from qualifying for APR, such as occupation of land by livestock, otherwise than to produce food for human consumption. For example, keeping birds such as pheasants for sport, and land use for fishing, shooting, and other sporting rights. However, it should be noted that land which is used for purposes of the above activities may qualify for BPR, provided that such activities are run as a business, where Laura will discuss more about the conditions for claiming BPR shortly. The next important thing to know is that APR is not given on the market value of the asset being transferred. APR is given as a percentage, either 50% or 100% of the agricultural value of the land. The agricultural value of the land will be different from the market value or development value, where land is worth more if it's capable of being developed rather than if its use has been restricted to agricultural purposes only. Therefore, the agricultural value is the value of the land, assuming it can only be used for farming purposes. And to work out the agricultural value of land, it is likely that a local land agent or land value will be required. So now we will move on to the relief that can be claimed through APR, where the big question is whether 50% or 100% relief can be claimed. There is only one instance when APR is given at a rate of 50%. For this 50% rate of APR to apply, the agricultural land must be tenanted. This means that the donor is the land to a farmer who is using it for agricultural purposes. As well as this, for the 50% rate to apply, this lease must have been signed before the 1st September 1995. Finally, the lease must have at least 2 years left to run at the date that the land is transferred. If all three of these conditions apply, APR is given at a rate of 50% of the agricultural value of the property being transferred. If any of the above conditions do not apply, APR is available at 100% of the agricultural value. So for the 100% rate, for this to apply, this will apply to non-tenanted land, so land which is owned and farmed by the farm themselves. And APR will also be available at 100% if there is tenanted land, but the lease is signed on or after the 1st September 1995, or if at the date the land is gifted, the lease will come to an end within 2 years. So what else do we need for the property to qualify for APR? The agricultural property must have been occupied by a transferor throughout the 2 years prior to transfer. In the case of tenanted land, this minimum requirement is extended to 7 years. However, there are some exceptions to the minimum 2-year or 7-year rule. If agricultural land is sold and replaced with new land, the new land will qualify for APR, provided that the combined period of ownership exceeds 2 out of the last 5 years. In the case of tenanted land, this is extended to 7 out of the last 10 years. As well as this, ownership periods can be aggregated where property passes from one spouse to another on death. And relief is also available in respect of successive transfers if the earlier or the later transfer is made on death, and where the value transferred by the earlier transfer is eligible for APR, and that property would be eligible for APR on a later transfer apart from the ownership condition. It's worth noting that these exceptions also apply to the required ownership period for BPR, which leads me on perfectly to pass over to Laura to talk about BPR now.
Okay, thank you, Lewis. Okay, so I'm now going to talk about BPR. So firstly, I'm going to look at what is relevant business property. So you can see from this slide, these are the different types of relevant business property. And there are also 2 different rates. So it's either at 100% or at 50%. So if you a sole trade business or a partnership share, or shares in an unlisted trading company, and there's no minimum holding requirement, those two types of relevant business property would qualify for BPR at 100%. And then shares in a quoted trading company, if the donor has voting control, so that's usually more than 50% of the ordinary shares, or land, buildings or plant and machinery owned by an individual and used either by their partnership or a company that they control, those two types of relevant business property would qualify for BPR at 50%. So there's some main points to be aware of in relation to BPR. So if shares are to qualify, they must be in a trading company. So shares in investment companies or property dealing companies will never qualify for BPR. Shares in overseas trading companies are eligible. And for the purposes of BPR, quoted means that the company has a full listing on the stock exchange. So AIM shares are treated as unlisted. So I think Lewis has already mentioned some ownership conditions for APR, but I'm just going to run through them again for BPR just to make sure it's really clear. So the general rule is that the donor must have owned the property for at least 2 years before the transfer. However, there is an exception. If old business property has been sold and then is replaced with new business property within 3 years, BPR will be available if the replacement asset is subsequently transferred, if the aggregated ownership periods total at least 2 of the 5 years immediately preceding the transfer. However, the BPR on the replacement asset cannot exceed the BPR that would have been available on the original asset, and there must be a tangible connection between the old and new property. So, for example, if the proceeds from the sale of the old property are used to buy the new property. Some other ownership points. So for spouses and civil partners, a donor's period of ownership can be aggregated with the donee's period if the transfer was between spouses or civil partners on death. And in relation to successive transfers, if there are successive transfers in a 2-year period, if the earlier transfer qualified for BPR and either of the 2 transfers were made on death, BPR will be given on the later transfer regardless of the ownership period. So there are some instances in relation to BPR when relief might be denied specifically. So that might be if there is a binding contract for sale of the asset at the date of the transfer, then HMRC will deny any BPR. This is often seen in partnership agreements where there's a clause which says that the shares should be sold to fellow partners on the death of a partner. However, a solution could be using cross options in the partnership agreement, and that could resolve the problem. BPR is denied if a winding up order has been made, a resolution for winding up has been passed, or the company is in the process of liquidation. For businesses where part of the activities are trading and part are non-trading or investment, relief will be denied if the business carried on consists wholly or mainly of dealing in securities, stocks or shares, land or buildings, or making or holding investments. So you'd need to look, if you do have a company where there is trading activities and non-trading activities, you'd need to look at the case law to determine whether this wholly or mainly rule applies. Also, something else to be aware of in relation to BPR is accepted assets. So BPR will be restricted on a transfer of shares if a company has accepted assets. And those are defined as assets which are neither used for the business throughout the 2 years immediately preceding a transfer, nor required for future use in the business. So the accepted assets would typically include shares held for investment purposes or large cash deposits that are not required for future use in the business. So where you have accepted assets, you need to do an apportionment. I'm going to put the calculation there on the slide. So if you take the qualifying transfer would be the gift times the total assets less the accepted assets divided by the total assets. Okay, so I'm going to pass over to Lewis, who's going to do our poll today.
Okay, let's try to launch the poll now. Okay, that should have come up now. So if you could all submit your answers, that would be great. So the question is, how often do you consider whether APR and BPR are available in relation to your clients? A, frequently, B, now and again, and then C, never. I'll give you a little bit more time to submit your answers. Okay, so it looks like we've got the majority of people have submitted answers. So the majority of people have gone for now and again, which is what I think we expected, because APR and BPR can sometimes go a little bit under the radar. But hopefully by the end of this webinar, you will all have more information on when these releases are applicable. Right, let me stop that poll. So we will now move on to how to claim APR or BPR. There isn't a specific claim for APR or BPR, but it would need to be included on the relevant IHT forms. For example, claim as part of the IHT 400 form that needs to be submitted on a death estate, or IHT 100 form for distributions out of trust. A point to note is that returns are usually still needed if no IHT is payable on a transfer, because APR or BPR reduces the transfer value by 100%. In particular, care should be taken with accepted transfers by individuals and accepted settlements when it comes to reporting requirements for APR and BPR. This is because the rules specifically exclude amounts on which BPR and APR have been claimed from the notional chargeable transfer when determining if a return is required. So if BPR and APR may reduce a chargeable transfer to nil, but a return may still be required. An example of this is a transfer out of a settlement if the chargeable transfer value ignoring BPR and APR is more than 80% of the available nil rate band. There are also instances such as if a farmer runs a farming business, they may be eligible for both APR and BPR on the same transfer. To prevent double relief, any part of the value transferred which is reduced by APR cannot be reduced by BPR. This means that where both APR and BPR apply to the same transfer, APR is given in priority. APR is available on land or buildings used for the purpose of agriculture. As discussed, this includes farmland and farm buildings, whereas BPR will then be available on assets used in the owner's farming business, which are not agricultural land or buildings. So this could be plant and machinery and business goodwill. Note that APR is restricted to the agricultural value of land and buildings, but BPR is not. Therefore, any development value within the farmland and buildings which is not eligible for APR may instead qualify for BPR. I'll now pass back to Laura for some final points to consider.
Okay, so just a few miscellaneous points to finish off with. So there may be additional tax on death on a lifetime transfer when the original gift was a gift of either agricultural or business property. And in certain instances, the APR or BPR given on a lifetime transfer will be withdrawn or denied when calculating the IHT due on the death of the donor. So there are specific conditions to consider in that circumstance. So you might see that when a pet becomes chargeable to IHT in the event of the donor's death within 7 years, or in the case of a CLT, an additional tax becoming due in the event of the donor's death within 7 years again. And also in relation to BPR specifically, you'd need to look at whether the company has actually ceased trading at the point of the transfer. So there's some important considerations to make there. So thank you very much for attending this morning. I hope you found it useful. So if you do have any questions after today that you think of in relation to these topics, please let us know. You can give us a call on the numbers on the screen there, and we can discuss any client situations that you'd like us to assist with. So our next seminar will be on Friday the 10th of June, and that will cover R&D, so research and development, and the reliefs in relation to that. So we're now going to see if we've got any questions. So Laura Brennan's going to ask us any questions that we've got from the chat bar. So if you'd like to stay on and listen to the questions, please do.
Hi everyone, so the first question is, can annual exemptions from IHT be preserved where APR or BPR relief is claimed?
I'll take this one, Laura. So the short answer is yes, they can, because APR and BPR are deducted from transfers before annual exemptions are used. So where 100% APR or BPR relief is available, such that the transfer of value is reduced to nil, annual exemptions will then be available to set against any later transfers in the same tax year, or they can be carried forward to the following tax year. Hopefully that gives a definitive answer to that question.
Great, thanks, Lewis. The next question was, would you have to make a claim for APR or BPR on the relevant forms where the transfer is a potentially exempt transfer?
So form IHT 100 is used to report lifetime tax and asks whether APR or BPR is being deducted from the transfer. If so, the relevant details should be included on the supplementary pages. However, this is not the case for potentially exempt transfers. For example, lifetime transfers of business or agricultural property between individuals. This is because potentially exempt transfers are not reportable unless and until the donor dies within 7 years of a transfer. So there would be nothing to report on the IHT 100 forms where the potential exempt transfer doesn't become chargeable.
Great, thanks, Lewis. I think we probably have one more time for one more question. So when might the BPR and APR given on a lifetime transfer be withdrawn or denied when calculating IHT due on the death of the donor?
Okay, so I think I was talking about that one. So in order for that to be available on the death, so the donee would have to have either retained the property until the death of the donor, or sold it and replaced it within 3 years with other business or agricultural property. But there are some specific conditions in relation to that. Another time when it might be withdrawn would be if the property retained no longer qualifies for APR or BPR. So for example, a gift of shares in an unquoted trading company which has subsequently become listed, and where it isn't a controlling shareholding. So that could be some instances where it might be withdrawn or not be available on the death of the donor. Okay, brilliant. So shall we move into the breakout room now, Laura?
Yeah, I think that's a good idea. If there are any other questions that have been submitted by the Q&A box, we can either give you a call or email you and get back to you regarding those.